Today, we are going to pull back the curtain on the world of U.S. bond ETFs. We're going to break down exactly how they work, from the super safe to the ones with a bit more punch, and help you figure out where they might fit into your own investment strategy.
So let me ask you something. Does keeping an eye on your investments ever feel like you're on a roller coaster? One day you're soaring, the next, not so much. That kind of volatility, especially with stocks, can be a pretty wild ride. Well, if stocks are the thrill ride, you can think of bonds as the seatbelt. They're what investors often use to bring a little bit of stability and predictability to a portfolio, really helping to smooth out those crazy ups and downs. But, and this is a big but, not all bond ETFs are created equal, not by a long shot. Okay, so let's start with the absolute foundation, the bedrock of the bond market: government debt. At its core, you're just lending money to the US government. Simple, right? Well, even here, things operate at two very different speeds, and knowing the difference is absolutely crucial. So what exactly is a U.S. Treasury bond? Put simply, it's just an IOU from the U.S. government. And because it's backed by the full faith and credit of the government, it's pretty much considered one of the safest investments on the entire planet when it comes to the risk of not getting paid back. Now here's the key. The biggest difference between various government bond ETFs really boils down to one single thing: how sensitive they are to changes in interest rates. This one factor is what shapes their entire risk profile. First up, we have the short and midterm treasuries. These are bonds that mature in about 1 to 10 years. Their main calling card? They're low risk. Because they're paid back sooner, their prices don't get tossed around as much when interest rates go up or down. This makes them a favorite for more conservative investors, or for folks who are just parking cash they might need relatively soon. Now let's jump to the other end of the pool: long-term treasuries, which are those with maturities over 10 years. Well, these are a completely different animal. They are highly sensitive to interest rate changes. If rates tick up, the value of these bonds can drop, sometimes pretty dramatically. So these are for investors who can stomach that volatility, and maybe they're making a bet that interest rates are actually going to fall. All right, time to switch gears. We're moving away from lending money to the government and into the world of lending money to companies. This introduces a whole new layer of risk and a huge spectrum of quality, from rock-solid corporations to much more speculative businesses. So what's a corporate bond? It's really just an IOU from a company. A business might issue them to raise cash to, say, build a new factory or expand their operations. The risk here isn't just about interest rates anymore. It's also about the financial health of that specific company. The big question is, can they actually pay you back? And that one simple question, can they pay you back, splits the entire corporate bond world right down the middle. It all comes down to something called credit quality, which is basically just a rating that scores how likely it is a company will default on its promises. On the safer side of things, you've got your investment-grade bonds. These are issued by big, financially stable companies, household names. They've got a medium level of risk, a little more than government bonds, sure, but in return, they offer a nice, steady stream of income. This makes them a real cornerstone for investors who want consistent returns. And then, you've got the other side of the tracks: high-yield bonds. You'll often hear these called junk bonds. And yeah, there's a reason for that. They're issued by companies with shakier finances, which makes them way riskier. There's a higher chance of default, and their value can get hammered if the economy turns sour. But here's the deal. To get people to take on that extra risk, these bonds have to offer a much higher potential return. Okay, so we've met our four main players: 2 from the government side, 2 from the corporate side. Now let's put them all on the same stage and see exactly how they compare in that classic battle of risk versus reward. This table really lays it all out. See how we start on the left with short-term government bonds? Lowest risk and, well, the lowest potential reward. But as you move across to the right, the stakes get higher. Long-term government bonds add that big interest rate risk, investment-grade corporate bonds bring in the risk of a company struggling, and all the way at the end, high-yield bonds pack the most risk, but also the highest potential for reward. And if that table didn't make it crystal clear, this chart really drives the point home. Look at the bars. For government bonds, risk and potential reward are low. But as you move over to investment grade and especially high yield, you can see both bars, risk and potential reward, climb up together. It's the perfect picture of that old saying, there's no such thing as a free lunch in investing. To get higher potential returns, you almost always have to take on more risk. So that covers the what and the why. But how about the how? When you actually own one of these bond ETFs, where does the money you get paid actually come from? Let's take a look under the hood. Your returns really come from three main places. First, and this is the big one, is the coupon income. Those are just the regular interest payments made by all the individual bonds sitting inside the fund. Second, if the bonds themselves go up in value, the fund manager can sell them for a profit, which creates capital gains. And third, you have small gains from the fund's day-to-day management as they buy and sell bonds to keep everything on track.
Okay, let's boil this all down. What's the one thing to remember for each? Short-term government bonds. Think stability. Long-term government bonds, that's a bet on interest rates. Investment-grade corporate bonds are all about that steady income. And high-yield bonds, you're chasing high growth potential, and you're okay with the risk that comes with it. And all of this brings us to the final and most important question, which is really for you to think about. Now that you can decode these different types of bond ETFs, from the safest seatbelts to the more high-octane engines of return, what role will they play in your financial future?